Dear ladies and gentlemen, my name is Thomas Gstädtner and I'm the president of the Supervisory Board of the EBI. I welcome all of you to today's policy series, and especially I would like to welcome our keynote speaker, Dr. Korbinian Ibel, Director General at the ECB, and our co-discussants, Giovanni Sabatini, Managing Director at the EBI, and Filippo Annunziata, Professor from the Academic Board of the EBI and the University of Bocconi. I will introduce all of the speakers in more detail a little bit later. Today's topic is about crypto assets, in particular the most recent Basel paper on the prudential treatment of banks' exposure to crypto assets. It was published in December 2022. The market for crypto assets is developing very fast, and banks are now assessing more and more how they want to get involved in this business. From a regulatory perspective, for the last years, the push for a stricter regulation of these assets has become also very loud. It has been highlighted, for example, by the EU Finance Commissioner McGuinness, that the collective activities of crypto assets providers are alarming if they're not regulated, and this is why there's a global need for principles around the whole crypto space. And on the face of these remarks from McGuinness, the borderless nature of cryptocurrency trading companies whose decentralized businesses can be scattered across physical territories and servers further underscores the need for a global approach for policing such assets. In the different continents, several regulatory initiatives have already been launched. In the EU, for example, when it comes to the regulation of the issuance of crypto assets and the services linked to such assets, MiCA has been published as a draft regulation at the end of 2020. We have dealt with MiCA at the previous policy series from the EBI, which can be seen on the EBI website. MiCA is supposed to enter into force in 2024 according to current plans. However, when it comes to the prudential treatment of banks' exposure to such assets, we now see with the Basel paper on banks' exposure to crypto assets a first start to dealing with this issue. This non-binding agreement now needs to be implemented into CRR and CRD. What this new standard means for banks, we want to discuss today with our speakers, and let me now introduce all of them in more detail. First of all, Dr. Korbinian Ibel, Director General at the European Central Bank. Korbinian serves since October 2020 as Director General of DG UDI, which supervises universal banks and diversified lenders. He joined the ECB in 2014 at the inception of the SSM and was responsible until September 2020 as DG for the Director General MS4. Korbinian is the representative of the SSM in the Basel Committee on Banking Supervision. He is also the co-chair of the Policy and Standards Group of the BCBS, which was responsible for drafting the crypto standard just approved by the GHOS. Previously, Korbinian was consultant at Accenture, followed by being a principal at the Boston Consulting Group. From 2008 to 2014, he worked at Commerzbank in various positions, including head of asset liability management, COO of Central and Eastern Europe, COO of Private Customers, and divisional board member, Group Risk Controlling and Capital Management. Korbinian holds a master degree and a PhD in economics and studied at the universities of Munich, Rotterdam, and Frankfurt. So welcome, Korbinian, and thanks for participating. Then I would like to introduce our co-discussants who will discuss then with Korbinian this topic. First of all, Giovanni Sabatini, who is the General Manager of the Italian Banking Association, the EBI. He is having this position since 2009. From 2008 to 2009, he worked for Consob, serving as Director of the Issuer Division. From 2006 to 2008, he served as Head of the Banking and Financial System Legal Affairs Directorate at the Italian Ministry of Economy and Finance. From 2004 to 2006, he was Director of Intermediaries Division at Consob, and beforehand he was also the CEO of Monte Titoli and Chairman of ECSDA, the European Central Securities Depositories Association. Giovanni graduated Economics and Business at Luis University and was term Professor of Business Financial Analysis at the Faculty of Management Engineering of the Sapienza University of Rome. Also to you, Giovanni, thanks very much for participating. And last but not least, Professor Dr. Filippo Annunziata, who is member of the Academic Board of the EBI and works at the University of the Bocconi University in Milan. Filippo is a member of the EBI Academic Board and Professor of Financial Markets and Banking Legislation and member of the Faculty of Legal Studies at Bocconi University. He's also a Professor of Musicology at the University degli Studi di Milano. We probably will not come back to this part of your expertise in today's policy series, Filippo, but it was very interesting. Then previously he was Professor of Financial Markets and Banking Legislation at the University of Bologna, where he also taught competition law and banking law. And before that, he was a tenured researcher for commercial law at Bocconi. Filippo holds a degree in economics from Bocconi University and musicology from the University of Milan, and he also holds a PhD in commercial law. So with this introduction of all the speakers, and again, thanks very much for you to participate, I would hand over to Korbinian now, who will start this event with his keynote speech. Thanks very much, Korbinian, and then over to you.
Yeah, thanks a lot, Thomas, and thanks a lot for the kind invitation to this event. I feel very honored to be with you today and to talk about crypto. So the already volatile world of crypto was recently appended anew by the collapse of one of its largest platforms, which highlighted risks from crypto assets and the inability of this nascent market to self-regulate. And the losses punctuated an already perilous period for crypto, which has lost trillions of dollars in market value. And Bitcoin, the largest, went recently down by almost 3/4 from its peak in late 2021, even if it in the last few days and weeks it went up a little bit again. During times of stress, I think we can see that we have seen market failures of stable coins, crypto-focused hedge funds, crypto exchanges, and all of this raised serious concerns about market integrity and user protection. So far, only one bank, and this bank not on our side of the Atlantic, has booked substantial losses because of an engagement with crypto assets in the failed exchange of FTX. But of course, with growing and deeper links with the core financial system, there could also be concerns about financial stability and a contagion effect to the banking market in the future. Many of these concerns can be addressed strengthening the financial regulation and supervision and by developing global standards that can be implemented consistently by national authorities. The important thing is that it's global, it's a global issue, so it needs global solutions. The ECB has played an active role in these initiatives and tried to establish a sound regulatory framework inspired by the principle of same activity, same risk, means same regulation and supervision. SSM banks have so far stayed largely away from crypto assets, while some of them have explored opportunities to use DLT technology, so distributed ledger, to increase efficiency, reduce cost, offer new services to clients, and this innovation is very much welcome. DLT has been used successfully for the issuance of tokenized securities like bonds issued by the EIB, repo transaction execution, settled payments, and other initiatives that are in the making. However, if banks were to take on exposures, either directly or indirectly, to crypto assets, they would face significant risks, and these would not be currently adequately covered by the Prudential framework. And therefore, a conservative global minimum Prudential framework is vital to protect the banking system from these risks. The Basel Committee of Banking Supervision, the BCBS, has finalized its standard on the prudential treatment of banks' crypto asset exposures. And this first standard that is agreed makes an important milestone in this respect. It provides a, first of all, harmonized international regulatory and supervisory approach to banks' crypto asset exposures. And second, it aims to balance responsible private sector innovation with sound bank risk management and financial stability concerns. From an EU perspective, the BCBS standard complements the forthcoming regulation of the crypto asset sector through the markets in crypto asset regulation. As a next step, it will be key for the European Union and other Basel jurisdictions to transpose this Basel standard into legislation. And the date foreseen for this is the 1st of January 2025 as a commonly agreed deadline. And the crypto asset concepts includes a broad range of various products with different risk profiles. And therefore, the standard, the BCPS standard, defines crypto assets as private digital assets that depend primarily on cryptography and DLTs or similar technologies. And digital assets here are defined as a digital representation in value, which can be used for payment or investment purposes to access a good or service. As you see, this definition is relatively broad and will cover most digital assets, including tokenized deposits, e-money tokens, and potentially also non-fungible tokens of NFTs. So the central bank digital currency, on the other hand, are currently out of scope of this BCPS standard. It should be emphasized that the risk weighting of crypto assets is not related to their accounting classification. Rather, it depends solely on the fulfillment of the condition and criteria under the BCPS standard, which divides crypto assets into two groups. And this standard, just before I try to explain it a little bit, is of course a pretty complicated standard. We try to have it simple, but the asset class is very complicated. So this is why we have all these different groups and categories. Now let me explain a bit. So group one includes tokenized traditional assets and crypto assets with effective stabilization mechanisms, so-called stable coins. These crypto assets must meet 4 classification conditions to ensure they pose a lower risk on banks' balance sheets. So these conditions include, first, assigning the legally enforceable rights arising from the crypto assets, then ensuring that the assets underlying network sufficiently mitigates material risks, as well as considerations regarding money laundering and the soundness of the information and communications technology arrangements. In Group 1, crypto assets are subject to capital requirements, basically based on the risk weights of the underlying exposures, that is the traditional assets, as they are set out in the current Basel framework. As an additional measure, supervisors can introduce also an add-on to the capital requirement for Group 1 exposures if weaknesses in the underlying infrastructure, such as the distributed ledger technologies, are observed. And then we have another group, that is Group 2. These are basically all crypto assets that do not meet any of the classification conditions for Group 1. And so these are also all unbacked crypto assets such as Bitcoin. As these crypto assets pose additional and much higher risks compared to Group 1, they are also subject to a newly prescribed very conservative capital treatment with a risk weight of 1,250%. However, for Group 2, if the crypto assets meet certain hedging recognition criteria, a limited degree of hedging is permitted. And the capital charge here for the netted position is applicable also only to the net positions. And then they are classified as something we call a Group 2A. These criteria include, for example, various thresholds relating to the market capitalization, trading volume, price observations that these crypto assets and their related hedging instruments would need to meet so that they are eligible and be included in Group 2A. In addition to the conservative capital treatment for Group 2 crypto assets, the BCPS standard includes an exposure limit. And this exposure limit is basically a safety belt, and it's a key policy tool to prevent transmission of shocks from crypto asset markets to the banking sector, and hence mitigated future financial stability risks. This backstop measure constrains the total amount of Group 2 crypto assets a bank can hold to generally below 1% of Tier 1 capital. Once a bank breaches this 1% limit, the more conservative Group 2B capital treatment will apply to the amount above 1%. If the 2% limit is breached, The entire group exposures are subject to Group 2B capital treatment. And this will ensure, hopefully, that banks have a strong incentive to not significantly exceed the 1% threshold. Other elements of the BCPS standard include clarity on applying the operational risk, liquidity, leverage, and large exposure limits to banks' crypto asset exposures, as well as rules on Pillar 3 disclosures. The standard is very clear about the fact that credit market and liquidity risk requirements will not apply to assets held under custody by banks. However, even the provision of custodial services entails exposures to risks, notably of operational nature, that have to be adequately managed and mitigated. Against this backdrop, the standard stresses that banks wishing to engage in crypto-related business need suitable governance and risk management arrangements. In particular, the decision to engage in such a business must be fully consistent with the bank's risk appetite and its strategic objectives as set down and approved by the bank's board. And in addition, banks are expected to consider the crypto-related business in their stress test analysis. So finally, one element of the BCPS standard is intended for supervisory authorities and includes rules on how to update supervisory practices to cater for the challenges posed by crypto-related operations and developments. So supervisory authorities may use a range of powers to tackle shortcomings in a bank's risk management, from additional capital charges to imposing limits on risk-taking and limits on business operation. Given the rapid pace of market developments, it's important to remain vigilant to the build-up and emergence of new risks. Over time, the Basel Committee will likely issue additional requirements and refinements or clarifications to this framework to ensure a consistent understanding and implementation of the standard and to address emerging risks. In any case, banks should follow a cautious and gradual approach when opening up these markets. The BCPS standard is not yet legally binding. It's pending on its transposition in the European Union law. However, should banks wish to engage in this market, they are already now expected to comply with the standard and take it into account in their business and capital planning. A call in this direction for a cautious approach was already made by the EBA when it published on 9th of January 2019 the report with advice for the European Commission on crypto assets. And banks in the SSM appear so far, I can clearly say, to have been very prudent. And with this, I would stop. Thanks a lot for your attention, and back to you, Thomas.
Thanks very much, Korbinian, for this very interesting presentation and laying out how this Basel paper is supposed to work. We would now move to Giovanni, maybe from a banking or banking association perspective, how you would see this business, and I would ask you for your opening statement.
Well, thank you for the invitation and for the opportunity to share with you my thoughts and ABI position on such complex issue. And also thanks to Korbinian for his very clear and informative presentation on the Basel rules for crypto assets. So let me start by noting that the problems posed to regulators and supervisors by crypto assets are not new and go back to early 80s of the last century, when the increasing use of technology in financial markets substantially changed the market microstructure and the role of financial intermediaries. The key issue was and still is how to find the right balance between the need to ensure financial stability, market integrity, investor protection, while avoiding to stifle financial innovation and the potential benefit it may have. A second major issue is that financial innovation allows to unregulated entities, IT companies, social networks, and others, to provide financial services and products. Here, the problem, as already noted by Korbinian, is that the traditional approach to regulation based on entities and not on activities may prove not adequate at addressing risks and may create also a level playing field in the competition between unregulated entities and regulated ones. So it's true that today the exponential speed of innovation adds new dimensions to the complexity of addressing the regulatory challenges posed by digitalization of financial markets and products. However, focusing on regulated entities only implies that risk may pile up outside the borders of regulation, with the potential to substantially impact financial stability where a crisis occurs. To go back to the last century, remember the lessons of the LTCM collapse and the spillover effects in 1997 and 1998 crisis in Russia and Asia. Through strengthening the controls and prudential requirements at regulated entities when dealing with unregulated entities or trading or offering digital products on behalf of their clients is the first line of defense. And considering the growing demand for crypto assets, we believe that the definition of a prudential treatment is a key component for a regulatory framework on crypto assets that would help mitigate the related risks and place these new instruments in a regulated environment. Only in this way, intermediaries could set up a sound and hopefully attractive offer in this new market segment. And as EBI, we actively contributed to the work carried out by the Basel Committee on Banking Supervision, aimed at the creation of an internationally harmonized standards for the prudential treatment of crypto assets by participating at both the two public consultation rounds in June 21 and June 22, and that led to the publication of the final report in December that has been brilliantly described by Korbinian. So the final BCBF framework remains quite conservative in terms of capital requirements, and the structure is generally unchanged from the proposals set out in the second consultation. So the categorization in the 4 groups. It's true that the final standards include also some improvements, enhancements we were advocating, and for which could contribute to create a better level playing field for all operators who are about to have exposure in crypto assets and or to offer services in this area. However, we believe there may still be some room for improvement in this prudential scheme. To be honest, the proposed prudential treatment of Group 2 crypto assets, the 12.50 times risk weight, and the 2% of the Tier 1 limit for total exposure represent potentially a very stringent limit to the provision of those services that are closely dependent on such exposure on behalf of banks. Banks, therefore, are penalized since they will not be able to compete on an equal footing with other entities, so fintechs, big techs, and other new players like crypto asset services providers, which will not be subject to the same capital requirements. And looking at the regulatory proposal at the European level and the MiCA proposal as reference, caps would be held to less strict regulatory and supervisory requirements. So again, I think prudential treatment will have to introduce the appropriate precautions to maintain financial stability and ensuring consumer protection. However, as I said, it should also ensure a level playing field between different market participants. And we think that banks, thanks to their expertise in risk management, could introduce the same appropriate safeguard they have on other asset classes within the crypto asset services offering. And in this regard, we recommend to remove any competitive advantage of less reliable actors to create a robust and resilient market and avoid any recurrence of what already happened. So that's why I'm strongly convinced that we need a more comprehensive regulatory framework that goes beyond the traditional approach, including increasing prudential requirements on regulated entities, and that an approach that ensures that the risks and challenges posed by crypto assets are adequately addressed independently from the entities that deal in those assets, and that goes beyond increasing the prudential requirements for banks, but be able to address all the dimension of risk posed by this new asset class. I could stop here, and I'm happy to answer further questions later on. Thank you.
Thank you very much, Giovanni, also for your opening remarks. We will come to the questions later on, and there will surely be some. Now moving on to Filippo, who has been looking into this topic very much also from an academic side. So maybe, Filippo, I hand over to you right away.
Yes, thank you. Thank you very much for inviting me. And thank you to the previous speakers that already provided very useful insights on this topic. Now, the way in which I see the system developing is clearly that of a more academic approach and looking at regulation, how it is moving. And we do have some great news coming up, because apparently, after having already enforced the DLT pilot regulation regime and also the DORA regulation that have been approved, the MiCA regulation is supposed to be approved in April. So I think that one of the big missing links in all the debate, where is regulation, where are the rules, is going to be pretty soon filled up, obviously, at least within the European Union. But the phenomenon is global, and we have to look at the international environment and building international standards. This will require time. But my impression, I might be completely wrong, is that once we have MiCA in the EU, we have a geopolitical bloc of 27 countries, which are quite significant. And the standards and the language, the methodology that we will have in place in Europe might serve at least as a starting global standard for other jurisdictions as well. Also because, on the one side, this regulation has a very persuasive intellectual force for two reasons. So it might be very influential. The two reasons are, first, that it builds on generally agreed upon international standards. For instance, if you look at the taxonomy of MiCA, the traditional division between payment tokens, utility tokens, investment tokens, this comes up from the dawn of crypto assets supervision and regulation. I'm talking, for instance, of the FINMA in Switzerland guidelines back in 2016 and 17 that provided this taxonomy approach that we are now following with all its limitation. I'm not saying it's perfect, but this is what's happening. So MiCA builds on that. The second fact is that MiCA is quite interesting because it builds a lot on market practice, and it takes up market practice and what industry has been developing, and obviously refines it and fixes a lot of things that haven't worked well. For instance, issues of custody, segregation of clients' assets. But let me make another example. The white paper is one of the key elements of the MiCA regulation when it comes to offering crypto assets on the market. And the white paper is a concept that's been taken up by from market practice and from the industry. So there's a bottom-up force of MiCA that make it less far away from industry and market practice than other examples that we've had in EU financial legislation. And for these two reasons, I think that MiCA might have a strong persuasive influence even outside the European Union. But at the same time, we have to move quickly. Even if MiCA is approved in April, it will have, at least in its current version, 18 months of transitional period, and it requires a lot of regulatory and technical implementing standards to be properly up and running before it comes into force. And 18 months of such a complex transitional period is probably too long. Industry, technology move very quickly, and there may be a risk that once the regulation is up and running, it is obsolete, at least in part, because things have changed in the meantime quite dramatically. I don't know how we can fix that, because there may be not sufficient space for an amendment to the transitional regime of MiCAR, but I just wanted to point out that unfortunately the transitional period is too long.
Thanks very much, Filippo, for your opening remarks. And we have now around about 30 minutes left for our Q&A session. Just in terms of technicality, so I have a few questions I've prepared also for our panelists right now, but also the audience can ask questions. We have a chat function, and if you write your questions in there, maybe also to who you would like to ask the question, then I will read them if it fits into the discussion or if you want to touch upon a new topic. In terms of the audience, maybe we have now more than 100 participants. Maybe just introduction of one person I have seen in the audience. Eduardo Fernandez Bolo from the Supervisory Board of the ECB has been speaking here before and as well. So also welcome to you, Eduardo. Okay, good. Then I would suggest I start with the first question, which I would ask to all the participants. I guess this discussion shows that crypto assets are no longer niche. I guess that's probably also the bottom line of this. The question is now, can regulators and supervisors catch up and coordinate a meaningful global response to this? I mean, at the moment, there have been a lot of initiatives in Europe. MiCA has been mentioned. Korbinian has introduced this first global approach. Question is now when this will be introduced into binding national legislation in the various continents of the world. But is it possible to have a meaningful global coordination of our supervision and regulation of such assets? And how can, again, regulators and supervisors strike the right balance between avoiding to stifle innovation and at the same time supervise the banks effectively? Yeah. And I guess one point that Giovanni has been mentioning is also the level playing field between less regulated entities. Yeah, how would this best work in this current environment? Maybe Korbinian, I hand over to you first of all. It's a bunch of questions in one. Maybe you can cover some of them, maybe all in your answer.
Yeah, thanks, Thomas. Let me give it a try. So you said, basically, as a first thing, crypto is not a niche anymore. I mean, if you compare it basically to the volumes that are traded in securities, then crypto, I think we can say, is still rather small. I think there's a crypto adoption index published in 2022, where they said that crypto ranks basically in no European Union member state is top 20 compared to the adoption rates of other countries. The only one big developed economy where crypto is really a little bit bigger or more present is the US. Even UK is ranked only as 17th country there. So I would say it's too big to ignore, but maybe it's still a bit of a niche, if we can agree on that. If you look at the data of the market capitalization, then the top 10 crypto assets capitalize something like 788 billion. I mean, depends. It was January, so now it might be a bit more with the latest rally. And 86% of that is made up of unbacked crypto assets. And that means that basically these are assets where still there is a big debate about what's the inherent value of these kind of assets, right? Is it just speculation? Is there a value? I mean, there are big camps which do not seem to be able to agree on that. But still, it's so big, it's clear that we as supervisors need to do something to fill the regulatory vacuum. And I think the FSB has done a great job on that. And here the Basel standard that we discussed here is also a big step in that direction. I think the Basel standard and the FSB is a clear signal that indeed there is a possibility to agree internationally. And it's not easy. It's always long discussions. It's always still, because it's so quickly developing, it's not so easy to find the right point in time where you do it. But we have to go there. And I think we are moving in that direction. I said already in my intro that we are guided by the principle, same activity, same risk, same regulation and supervision. And this is also where we try to basically do our contribution to the level playing field, right? But still, I see the points that were mentioned, that one has to be careful about banks' competitive position. On the other hand, of course, banks have additional risks because they have depositors, etc. So it's not exactly the same as a crypto exchange. A bank is a little bit a different entity. So to summarize, all in all, I think it's big. It's maybe still a bit a niche in some things, but niches can also be very, very dangerous in terms of contagion effects. And this Basel standard basically has these two goals. First of all, make sure that innovation and development can continue, and on the other hand, avoid financial risks and contagion. And I think this was achieved by that standard. And here I would stop and hand back to you, Thomas.
Thank you very much. Then Giovanni, maybe?
Yes, well, I tend to agree with what Korbinian said, that compared with other asset class, crypto assets are still a small market. Although the interest is growing in the United States, 12% of adult individuals say that they have used or held crypto assets in 2021. Of course, in Europe is a smaller percentage. According to a study on payment attitude of consumers in the euro area space, the share of holders is estimated only 4%. But I think what is worrying is that from the BIS working paper published in November, there is quite alarming figures. From 73 to 81% of users had likely lost money on their investment in crypto assets. So I think that's, notwithstanding it is a small market, there is a growing interest, and there are substantial risks embedded in it. Therefore, that's why we think it has to be regulated, also to preserve the value of this market. This being said, I think that two limits of regulation emerged. The first one is geographical limits, but I agree in this area, the Financial Stability Board has a key role in order to ensure the agreement on international standards. The second one is also to have regulation that is not addressed to regulated entities only. Here we have first point, how to preserve market integrity. I wonder whether we have sufficient information on the dimension of this on these crypto asset markets. I wonder whether we may need also transparency requirement and ask all participants in the market to report to the supervisors their exposure in the market, in order to avoid in a crisis that you have a substantial spillover effect for this market into regulated financial market. The second issue, again, is about rule of conduct to preserve, to ensure investor protection. Of course, this applies to banks and other regulated entities. I wonder whether these rules should be applicable also to other entities offering this product. And finally, again, I recognize that for financial stability, capital requirements are key. But again, I wonder whether we could ask also other entities, not supervised entity, to meet additional capital requirements, again, in order to preserve financial stability and avoiding the risk that risks move from the regulated world into the unregulated and undetected world.
Thanks very much, Giovanni and Filippo. Maybe I also can add to this point here a question asked by John Taylor. I don't know whether you have knowledge whether there's any plans right now, and he's basically saying, well, there's that this proposed regulation that Korbinian has introduced is obviously applying to banks and not to fintechs or other non-bank financial enterprises. Is there anything planned? Maybe you can add this also to your question to the extent you know what is planned in this regard, Filippo.
Well, on a more general plan, what we can say is that crypto assets are probably still a niche, but technology instead is developing very fast and very well in some respects. So we have to distinguish between the products and the underlying technology. And we have to be careful so that we do not throw away one with the other if we want to throw away something. A good example of how you can combine a flexible regulatory approach by upholding technological development is the DLT pilot regime regulation. That allows for some kind of experimentation, let's use the word sandbox, in order to develop projects that use the underlying technology, but in a protected environment where they can develop and grow and deploy all their capabilities. I think this is a good example, and I would suggest that we consider extending the scope of the DLT pilot regime, which today is probably too narrow. It's capped in terms of amounts and also limited in terms of scope, and extended to other sectors as well. For instance, why not think of a EU sandbox pilot regime for private stable coins or even e-money tokens? This could be a good way to help the industry develop in an orderly way without having to face all the costs and expenses that would otherwise be implied if these projects were to be developed under current regulations. So I think that, yes, crypto assets are probably still a niche as such. The crypto winter is probably not over yet, even if we have signs of the market recovering, but I wouldn't expect to have such a major development. But we need technology to be kept alive. This technology is very interesting and very useful in all across the entire financial industry. And by investing on pilot regimes, sandbox regimes, without opening the door to regulatory arbitrage, obviously, I'm talking about protected environments, I think that we can move ahead in quite an interesting way. As to international standards, well, actually, this morning at 6 in the morning, I was connected with a Financial Stability Board meeting in Tokyo, where we discussed the standards that they just issued. Now, obviously, the approaches are still quite divergent from one system to the other, but the basic principles, I see that they are consolidating, also as a response to market failures. As always, we see that market failures, financial crises and panics have the capability of sort of exhorting regulators to elaborate some kind of common principles. And probably the crypto winter has been useful in this respect, because there seems to be greater sort of acknowledgement of some kind of risks that this industry raises and how to address them. And once again, I believe that the MiCA standard will be a very important international standard that other systems will necessarily have to look at and consider. I'm not saying that the entire globe will adopt the MiCA approach, obviously, but the fundamental principles that we have in there seem to be in some way agreed upon in other jurisdictions as well.
Thank you very much, Filippo. Maybe before we move to the question how supervision will react on this new business, just a question beforehand. I mean, how do you think banks and the banking business will change because of this crypto assets, the crypto business, and all the technology being involved in this? Korbinian, maybe you have a view on this.
Yeah, I mean, of course, this is an excellent question, and none of us has the crystal ball, right? And it depends a lot how it's going to develop. But what is basically pretty easy to imagine is that banks will use the technology and continue to use it in terms of changing the way they do payments in the future. This is something that can be, I think, truly expected. The other thing is basically so this is the question is how do they use the technology? And I think there are many ideas out there, innovative ideas, if you read different reports, but it's still idea phase, I would say, or ideation. So people are trying things. So far, at least to my knowledge, I speak under the control of the colleagues. I have not seen that breakthrough where suddenly things really change dramatically using the technology in a normal banking environment, but that still might come. The other thing is, of course, what does crypto do to banking at all? And this is something I think also here, the question is still open. This is still, as I said, in my point, a niche, even if it's too big to ignore. But if you think about liquidity management, will at a certain point in time, crypto take over normal liquidity management, normal payments? Will that happen, yes or no? I don't think so, but could it happen theoretically? Of course. And of course, it depends a lot on regulation, but it also depends on which players are entering the market. So far, crypto is still in many aspects a little bit a shady thing, I think we can say. And what happens if really serious players would enter? And that is still not 100% clear. So I think here, at least in my view, it's still too early to say, Thomas. It's too early to say, but we should be open and vigilant and looking at all different aspects. And we should also make sure that we do not kill innovation, because maybe really there is something there that really improves bank situation in the future for the benefit of the people, because you get it cheaper, safer, better. And then we should not be with the ones who block it. That's my view.
Thanks, Korbinian. Maybe Filippo, you have a view on this as well, or any idea?
I fully agree, because it sort of elaborates on what I was trying to anticipate. One thing is technology. The other thing is the misuse of technology for this phenomenon. And technology is developing very fast, and I think it will be integrated into existing business models and even support the development of new business models. What's happening, at least from what I see, is quite similar to the artificial intelligence debate, which is the other big tech area that is developing. If you look at the recent reports, I'm referring to the very recent study published, for instance, by ESMA just a few weeks ago on what's happening in the context of the financial industry, especially capital markets, considering the use of artificial intelligence. You see that on the one side, developments are very interesting, but they are not as disruptive as we thought. Actually, artificial intelligence is being embedded and used in order to foster the development of existing products and services, to improve their efficiency, to reduce the cost. And it's not really sort of turning humans into machines, which is what some of us expected just a couple of years ago. But the traditional business model is being supported and developed by new technology. And I see this is what's happening in the banking industry, especially payments, as Korbinian was anticipating, are being affected, because also artificial intelligence, the biggest impact is one of the biggest impacts vis-a-vis the use of by consumers is in the payments industry. And this is developing in quite an innovative and interesting way. So let's try and support technology without sort of suffocating the phenomenon, even if it has had its flaws and shortcomings in the past months.
Thanks very much, Filippo. Maybe then one question to round this up a little bit. I mean, Korbinian, you said that banks have not been too active so far when it comes to crypto projects, yeah? But when it comes to supervision right now, it's obviously also a question which will affect you in your day-to-day job. When banks will start approaching the ECB more and more with these kind of projects, I guess having expertise in this extremely new technology is not the core of a supervisor's work, of course. But what is the ECB already doing when it comes to these kind of assets? And are the banks already approaching the ECB, or when do you expect banks to approach the ECB more and more with these requests for crypto business?
I think, Thomas, it's fair to say that the banks approach us already. Yeah, I mean, it's not a mass phenomenon, I would say, but it happens. And so far, the ECB has always been, let's say, open but careful. So we try to make sure that that the business risks are well understood, the risk appetite is well understood, the risk management is in place, but we are not blocking it. And in some countries like Germany, you have also this licensing where we also, as the SSM, play a role, of course, if it's a significant institution. And in all these things, I hope the industry sees us being, as I said, careful but constructive. Yeah, this is the approach we want to take. And still, I would say, so far, at least to me, it all seems to be testing phase, which might exactly be the right thing in such a quickly developing technology. It might be very smart of the banks, very, very considerate to go in that way, but it's still in that sphere that we see the approaches.
Thank you, Korbinian. Maybe then one point I wanted to ask regarding, let's say, the further development of crypto supervision. I mean, this is now, I guess, on a global scale, one of the first standards that we are seeing, or the first one actually. How do you think this will further evolve? Is there anything else in the planning when it comes to crypto supervision and for example, also decentralized finance?
Yeah, I think so. So, I mean, the standard, let's be clear, the standard is, I think, a great achievement, because the first time that people came together on the global scale and really agreed on a technical standard, on technical details, because it's always the devil is in the detail, right? And so this is a big achievement, but let's also be fair, there are some review clauses in that standard, because some things still need to be checked and controlled. And then we have 2025 is the deadline for implementation. Now we know these deadlines are always stretch goals. They are ambitious goals. This is what we want all to achieve. But we also know that political issues might be in the way. So what I want to say is, yes, we have achieved that, but this is not the standard, and it's now put in stone for the next decade. This is not what's going to happen in such a quickly developing market. I personally can only talk about banking, and this is the Basel committee. So there might be other committees which are currently working on it. Yeah, I think maybe Filippo even knows more than me about it, and can say a few more things about what he sees in other spheres.
Thank you, Korbinian. Maybe I start with Giovanni first of all.
Well, I think that your question is also linked to the how banks will develop new products and services using crypto assets. Because I think that the definition of an appropriate regulatory framework, it will be essential on the one hand to overcome the so-called crypto winter, and therefore we need a consistent, coordinated and proportionate approach to regulation of these assets. And this will also help banks to develop new services and products. However, regulation per se is not the only way. I think we need also other two components. First, I think it is essential to continue with the sandbox approach, where banks and other entities can test their products, their services, let's say, in a protected environment. And also we need financial education to ensure that investors, and particularly retail investors, are aware of the risks and may also better understand that sometimes, let's say, the administrative burdens required when they are dealing with banks are also needed to ensure their protection. So I think these are three elements that will help to develop further the market for crypto assets in a safe way.
Thank you, Giovanni. And Filippo?
Looking at supervision and enforcement, now actually, and quite obviously, we're talking about technology and oriented environment. So I would certainly uphold the development of the whole array of RegTech and SupTech instruments that are already being tested, maybe in other areas of financial markets regulation and supervision, but also in the banking one as well. So I think this is an area that we have to develop. But looking at supervision, I would warn that we're on the one side, we're building a comprehensive EU regulation on crypto assets, and this is fine. But there's a weak spot in all of this, and we already discussed this, Thomas, in other EBI series workshops, which is taxonomy. The need to be extremely clear as to the nature of the crypto asset and the crypto asset service provider as a consequence. What is this crypto asset and where does it fall within the landscape of EU regulation? Is it really a utility token? Is it a payment token? Is it a financial instrument? Now, we know that MiCA, unfortunately, takes this issue of taxonomy too lightly, at least in my view, because it simply says, you know what already falls under existing EU financial regulation will not be regulated by MiCA. By the way, with a contradictory approach, because e-money tokens, which is simply electronic money tokenized, is fully regulated by MiCA on top of the existing rules. And this also challenges the regulatory neutrality approach that we've been discussing. But apart from that, the danger that we misinterpret the nature, misunderstand the nature of a crypto asset has dramatic effects for supervision and enforcement, because you may have one country, one authority in one member state that looks at a crypto asset, which is a bit sort of difficult to understand, and says this is a financial instrument or this is a payment token. But in another country, classification may be different. And also this situation is exacerbated by the fact that in some EU member states, you have further notions that you use under national law that may complicate the picture. For instance, the notion of financial product that we have in Italy has got little to do with the financial instrument of MiFID, but it's a purely national definition that we apply to the public offering of securities that do not fall under the prospectus regulation. And just a few months ago, we've had some very important criminal law cases decided by our Supreme Court that have concluded that Bitcoin, which is not covered by MiCA, and we know this is a shortcoming of the regulation, but Bitcoin is a financial product for the purpose of Italian legislation. And problems of taxonomy in classifying correctly and applying the correct uniform legal regime to crypto assets is a fundamental part of MiCA. And enforcement and supervision will be weak, and the market will be very fragmented if we do not solve this issue, which may be in the hands of technical standards. We know that this has been addressed in the latest versions of MiCA, but we have a lot of work to do because the principle is simply there. We have to develop common criteria and technical standards, but we have to start and work on that, and the sooner the better.
Thanks, Filippo. We're almost at the end of time, or actually we are now at the end of time, but maybe one quick question to the group, or maybe to Korbinian again, when it comes to the interaction between MiCA and this new Basel standard. Yeah, I mean, I guess this Basel standard, you have explained this very well, is that essentially the supervisors, the regulators, they're like the group 1 assets for banks to have exposure to. They're kind of treated like other ones as well. And they don't like very much exposure to group 2 assets, yeah, when it comes to crypto. Do you think it's going to be some kind of linked to MiCA in the sense that if you have a MiCA approved crypto asset, it will more likely fall into group 1? I mean, obviously you have these criteria, but is this kind of the direction that you see?
Yeah, let me first say something else regarding Filippo's comments. So this about the taxonomy, etc. I think that is a very valid point. Yeah, this is why we created in the Basel committee paper a coordination mechanism, where we as supervisors want to compare notes how we classify. But I think this is spot on because it's too complex to already now foresee for all future where you classify something. So the only way that helps if you talk about it. Yeah, what did you do? What did the others do? So I think this is a super valid point, and it's a difficulty in any standard or law you provide. Yeah, and we need to keep here a little bit of flexibility. To your other point, yes, indeed. Yeah, so the Basel standard foresees basically in these criteria also that it needs to be regulated, and this is where MiCA will come into place. If MiCA is then the only criteria, and if this is to be seen, yeah, but yes, this is exactly the idea. And of course, MiCA only exists here, and other regulations will start to exist in other countries. And this is where then we need to come back together at the Basel table and check that we apply same criteria for the same kind of activity. So this is why you see my answer not as clear cut as you might expect it, but rather as something like, yes, that is the idea, but let's see a little bit how it's implemented in the end.
Very good. Thanks so much, Korbinian. And now looking at the time, I would also close now this event. And thank you very much again, Korbinian, Giovanni and Filippo for participating as speakers to this event. I think it was very interesting. Also to the audience, thank you very much and all have a great rest of the week. Bye-bye.
Thank you, Thomas. Bye.
Thank you very much. Bye.
Bye, Filippo.